Alright everyone, and welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 18th of April 2023, and just before I get into the session, you do need to be aware that what I say is general advice only. It does not consider your personal financial circumstances. You have to decide whether it's appropriate for you. So it's earnings week in the US. Well, really it started last week, but it's really getting on in earnest this week. We've got several major names reporting tonight. We've got Bank of America, we've got Goldman Sachs, we've got a whole host of others, and there's already been a few major stocks that have reported so far as well. So far the earnings season has been going pretty well. I think the most recent statistic I've read was about 77% of businesses have beaten their earnings expectations. That does sound extremely high, but in the US, roughly 70% of businesses usually exceed their earnings expectations. So it's only slightly better than normal. We'll be looking for lots of sort of data points this season, basically whether revenues start really sort of dwindling from here. We'll be looking at sort of forward guidance. We'll be looking at sort of how the market responds to positive and negative earnings reports. Realistically, there's going to be a lot of insights this season, and the events of this week could very easily determine whether markets continue on their current upwards move or whether they start to reverse and see a bearish turnaround. We'll know more in the next weekly update, so I'll give you guys an update in that one. Next thing I wanted to talk about is economic data, and there's a bit of a divergence between Australian and US economic data at the moment. In the US, economic data continues to weaken. It continues to come in, slightly worse than expected. It continues to decline, and that really points to their slowing inflation data as well. Their CPI data came in showing that inflation is continuing to slow, showing that people are basically either tightening the purse strings, or at least businesses aren't continuing to lift prices. So in the US, their data is seen as supporting the deflationary argument, and it's seen as giving justification to their Federal Reserve to pause on the interest rate increases. Now, if you go and have a look at the economist predictions and things like that, most people are expecting one more rate rise at the May meeting from the US Federal Reserve, and then that's it. So they're expecting one more and then a pause, and then history shows once a pause has happened, it's usually not too long until rates started being lowered. And so if you go and look at the expectations, many economists are predicting that by the end of the year we'll start to see rates being lowered. That's in the US. Here in Australia, we've already had the pause, and the pause looks a bit premature given some of our recent strong economic data. Recently, we had really strong unemployment data, unemployment at 3.5%, extremely low. We had way more full-time jobs created than expected. Unemployment even stayed very low with a lift in the participation rate. Now, all of that points to a very strong jobs market in Australia, and that's inflationary. That strong jobs market basically says that maybe we're going to see lifts in wages. Maybe we're going to see people able to spend more as a result. And that data basically somewhat embarrasses our Reserve Bank, who paused the interest rate increases based on a belief that inflation was coming under control. Now, next week we're going to see Australian CPI data. It's still probably going to show up more than 7% price growth year on year, and that may, combined with the unemployment data, may cause the RBA to resume their rate increases when they meet on the 3rd of May, I believe it is. And so once again, the RBA looking a little bit silly and perhaps pausing the rate rises too soon, whereas the US continuing to go with the rate rises, but the data is suggesting they may soon pause there. So what does this mean for the Australian market? Well, we've seen Australian government bond yields start pushing up. So the Australian government bond yields have started pushing up across the past week with the strong economic data, and they're basically pointing to a resumption of rate rises, perhaps one more rate rise from our RBA, maybe in May, and then perhaps in June. And so those bond yields rising have not been great for our equity market. And overseas equity markets have really continued rallying, particularly in the US and Europe. They've continued rallying with a peak rate hope, whereas our markets really sort of stalled across the past week, and that's been led by those bond yields rising. That's been led by perhaps a belief that the RBA is going to raise once more in May. So if you have a look at the stock markets, the indices, this is the Australian XJO. It's had a fantastic month or so. It's up about 7% since the lows of March, but across the past week, across the past 5 sessions, it's largely unchanged. Largely unchanged. Now it is at a key technical level. We've got a potential resistance level around 73.50 to 73.70. So maybe you could argue there's some technical factors at play in our stall in the upwards movement. But I think you also have to look at the bond yields over this time, and if you did, you'd say they're rising again. They're basically saying maybe the RBA is going to go again, and as a result, that's straining our equity markets, really stalling our current upwards move right around 73.60. If we have a look at the US market, they're continuing on their overall upwards move. There has been a little bit of a lull here, but it looks like it's going to continue higher. And these past few sessions in particular are seemingly being driven by strong company earnings results. A lot of the large cap stocks that have reported so far have had big jumps in price on the back of their results. And for me in the US, they look like they've got a bit more room up to that 4,200 level, which is, I think, the upside target on the current move. There was a potential resistance level at maybe 41.30 here, but they broke through that. They tested it, and they continued higher. They sort of held above it. So for me, the US looking a bit further bullish, while our own market is already at its inflection point and no longer looking quite as bullish. The indicators are suggesting both markets are overbought. There is a lot of uncertainty about the economic outlook for the rest of this year, and so it really it does look like equities are starting to run out of steam in the current move. I'd be cautious going long. I'd be cautious going short. I'd be waiting for the next very clear signal. And until then, I hope you've enjoyed the video, guys, and I'll hopefully see you in the next one. Bye for now.